Welcome. Today we're diving into how you can create a stock investment strategy that truly works for you. Whether you're just starting out or looking to refine your approach, having a clear plan is essential. A solid strategy helps you navigate the ups and downs of the market, manage your emotions, and stay focused on your long-term goals. In this video, we'll break down the key steps to building your own personalized investment plan so you can invest with confidence and clarity. Let's get started by understanding why a strategy matters in the first place. Investing without a strategy is like sailing without a map. The stock market can be unpredictable, and emotions often run high when money is involved. A well-thought-out strategy acts as your guide, helping you make rational decisions even during market turbulence. It keeps you disciplined, reduces impulsive actions, and increases your chances of achieving your financial goals. By having a plan, you're less likely to panic during downturns or get swept up in market hype. Next, let's talk about setting your investment goals. Before you invest a single dollar, it's important to define what you want to achieve. Are you saving for retirement, a house, or your child's education? Your goals will shape your investment choices and time horizon. Be specific, set measurable targets and deadlines. For example, you might aim to build a $100,000 portfolio in 10 years. Clear goals give your strategy direction and help you track your progress. Now, let's look at how your risk tolerance fits into the picture. Risk tolerance is all about how much risk you're comfortable taking with your investments. Some people can handle big swings in their portfolio, while others prefer a steadier ride. Knowing your risk tolerance helps you choose the right mix of stocks and other assets. It's influenced by factors like your age, income, financial responsibilities, and personality. Take some time to honestly assess how much risk you can handle without losing sleep. Up next, we'll explore different investment styles. There are many ways to invest in stocks, and your style should match your personality and goals. Some investors prefer a hands-on approach, picking individual stocks and actively managing their portfolio. Others like a more passive style, using index funds or ETF to track the market. There's no one-size-fits-all answer. What matters is finding a style that fits your lifestyle and keeps you engaged. Next, let's talk about how to diversify your investment. Diversification means spreading your investments across different stocks, sectors, or even asset classes. This reduces the risk that any single investment will hurt your portfolio too much. By owning a mix of assets, you can smooth out the bumps and improve your chances of long-term success. Think of it as not putting all your eggs in one basket. We'll now look at how to research and select stocks for your portfolio. Good research is the foundation of smart investing. Start by learning about the companies you're interested in, look at their financial health, business model, and industry trends, read annual reports, earnings statements, and news articles. Pay attention to key metrics like revenue, profit, and debt. The more you know, the better decisions you'll make. Next, let's discuss how to evaluate a stock's value before buying. Before you buy a stock, it's important to determine if it's fairly priced. This involves looking at valuation metrics like the price-to-earnings (PE) ratio, price-to-book (PB) ratio, and dividend yield. Compare these numbers to industry averages and the company's historical values. Remember, a low price doesn't always mean a good deal, and a high price isn't always bad. Up next, let's talk about building your portfolio step by step. Now it's time to put your plan into action. Start by deciding how much money you want to invest and how you'll allocate it among different stocks or funds. Don't feel pressured to invest everything at once. Consider dollar cost averaging, which means investing a fixed amount regularly. This approach helps reduce the impact of market volatility. Next, let's cover how to monitor your investments over time. Once you've built your portfolio, it's important to keep an eye on how it's performing. Regularly review your holdings to make sure they still fit your goals and risk tolerance. Watch for changes in the companies you own as well as shifts in the broader market. However, avoid checking your portfolio obsessively. Too much monitoring can lead to emotional decisions. Next, let's discuss when and how to rebalance your portfolio. Over time, some investments may grow faster than others, causing your portfolio to drift from your original allocation. Rebalancing means adjusting your holdings to get back to your target mix. This might involve selling some winners and buying more of other assets. Regular rebalancing helps you manage risk and stay on track with your strategy. Next, let's look at how to handle market volatility. Stock market is known for its ups and downs. It's normal to feel uneasy during big swings, but remember that volatility is part of investing. Stick to your strategy and avoid making impulsive decisions based on short-term market movements. Having a plan in place helps you stay calm and focused on your long-term goals. Next, let's talk about the importance of ongoing education. The world of investing is always evolving. New trends, technologies, and regulations can impact the market. Make it a habit to keep learning, read books, follow financial news, and consider taking courses. The more you know, the better equipped you'll be to adapt your strategy as needed. Up next, let's discuss the role of emotions in investing. Emotions can be one of the biggest obstacles to successful investing. Fear and greed often drive people to make poor decisions like selling during a downturn or chasing hot stocks. Recognize your emotional triggers and develop strategies to manage them. Sticking to your plan and having clear rules can help you stay objective. Next, let's look at the importance of patience in investing. Investing is a marathon, not a sprint. It takes time for your investments to grow and compound. Patience is key. Don't expect overnight success. By staying committed to your strategy and giving your investments time to work, you'll increase your chances of reaching your goals. Next, let's talk about the importance of reviewing your strategy periodically. Life changes, and so should your investment strategy. Review your plan at least once a year or whenever you experience major life events like a new job or a growing family. Make adjustments as needed to stay aligned with your goals and risk tolerance. Regular reviews keep your strategy relevant and effective. Next, let's discuss the importance of keeping costs low. Fees and expenses can eat into your returns over time. Choose low-cost investment options like index funds or ETFs whenever possible. Pay attention to trading commissions, management fees, and other charges. Keeping costs low means more of your money stays invested and working for you. Next, let's talk about the benefits of automation in investing. Automation can make investing easier and more consistent. Set up automatic transfers to your investment account and schedule regular purchases of stocks or funds. This approach helps you stay disciplined and removes the temptation to time the market. Automation also makes it easier to stick to your plan even when life gets busy. Next, let's look at the importance of having an emergency fund. Before you invest, make sure you have an emergency fund in place. This is money set aside for unexpected expenses like medical bills or car repairs. An emergency fund gives you peace of mind and prevents you from having to sell investments at a bad time. Aim for 3 to 6 months worth of living expenses. Next, let's discuss the role of taxes in your investment strategy. Taxes can have a big impact on your investment returns. Understand how capital gains, dividends, and other investment income are taxed in your country. Use tax-advantaged accounts when possible, like IRAs or 401(k)s in the US. Smart tax planning can help you keep more of your hard-earned money. Next, let's talk about the importance of keeping good records. Accurate record keeping is essential for successful investing. Track your purchases, sales, dividends, and fees. Good records make it easier to file taxes, monitor your performance, and make informed decisions. Use spreadsheets, apps, or your broker's tools to stay organized. Next, let's discuss the value of seeking professional advice when needed. Sometimes it makes sense to consult a financial advisor, especially if you have complex needs or large sums to invest. A professional can help you clarify your goals, build a tailored strategy, and avoid common mistakes. Just be sure to choose an advisor who is transparent about fees and puts your interests first. Next, let's talk about the importance of staying flexible. Markets and personal circumstances change over time. Being flexible means you're willing to adjust your strategy when necessary. Don't be afraid to make changes if your goals shift or if new opportunities arise. Flexibility helps you stay resilient and make the most of your investments. Next, let's discuss the importance of avoiding common investment mistakes. Every investor makes mistakes, but learning from them is key. Common errors include chasing hot stocks, ignoring fees, and failing to diversify. Stay focused on your plan and avoid shortcuts. Remember, slow and steady wins the race. Next, let's talk about the importance of setting realistic expectations. It's important to have realistic expectations about what investing can achieve. The stock market offers great potential, but it also comes with risks. Don't expect to get rich overnight. Focus on steady, long-term growth and be prepared for setbacks along the way. Next, let's discuss the importance of aligning your investments with your values. Many investors want their money to reflect their personal values. Consider socially responsible investing or choosing companies that align with your beliefs. This approach can add meaning to your investment journey and keep you motivated. Next, let's talk about the importance of staying informed about the economy and markets. Keeping up with economic news and market trends helps you make better decisions. Subscribe to reputable financial publications, follow market updates, and stay aware of global events that could impact your investments. Being informed allows you to spot opportunities and avoid surprises. Next, let's discuss the importance of networking with other investors. Connecting with other investors can provide valuable insights and support. Join investment clubs, online forums, or social media groups to share experiences and learn from others. Networking helps you stay motivated and exposes you to different perspectives. Next, let's talk about the importance of protecting your investments. Security is a crucial part of any investment strategy. Use strong passwords, enable two-factor authentication, and be cautious with your personal information. Choose reputable brokers and keep your accounts secure. Protecting your investments helps you avoid losses due to fraud or cyberattacks. Next, let's discuss the importance of reviewing your beneficiaries. Make sure your investment accounts have up-to-date beneficiary information. This ensures your assets go to the right people if something happens to you. Review your beneficiaries regularly, especially after major life events. Keeping this information current is an important part of your overall strategy. Next, let's talk about the role of insurance in your financial plan. Insurance can protect you and your family from financial setbacks. Consider life, health, and disability insurance as part of your overall plan. The right coverage helps you manage risks and provides peace of mind. Next, let's discuss the importance of estate planning for investors. Estate planning ensures your assets are distributed according to your wishes. Create a will, assign power of attorney, and consider setting up trusts if needed. Good estate planning protects your loved ones and keeps your investment strategy on track even after you're gone. Next, let's talk about the importance of goal setting for different life stages. Your investment goals may change as you move through different stages of life. Early in your career, you might focus on growth. Later, you may prioritize income or capital preservation. Adjust your strategy as your needs evolve. Next, let's discuss the importance of teaching financial literacy to your family. Sharing your knowledge with family members helps them make smart financial decisions. Teach your children or loved ones about saving, investing, and budgeting. Financial literacy empowers the next generation and supports your family's long-term success. Next, let's talk about the importance of celebrating milestones. Reaching your investment goals is a big achievement. Take time to celebrate your progress, whether it's hitting a savings target or seeing your portfolio grow. Recognizing milestones keeps you motivated and reinforces good habits. Next, let's discuss the importance of giving back. Many investors find fulfillment in giving back to their communities. Consider donating to causes you care about or supporting charitable organizations. Giving back can be a rewarding part of your investment journey. Next, let's talk about the importance of reviewing your progress regularly. Checking in on your progress helps you stay on track. Set aside time every few months to review your goals, performance, and strategy. Make adjustments as needed to keep moving forward. Regular reviews help you catch problems early and celebrate your successes. Next, let's discuss the importance of staying true to your plan. It's easy to get distracted by market noise or the latest trends. Remember why you started and stick to your plan even when it's tempting to make changes. Consistency is key to long-term success. Next, let's talk about the importance of celebrating your unique journey. Everyone's investment journey is different. Your goals, risk tolerance, and experiences are unique to you. Embrace your path and don't compare yourself to others. Focus on what works for you and keep moving forward. Next, let's discuss the importance of adapting to change. Change is inevitable both in life and in the markets. Be open to adjusting your strategy as circumstances evolve. Flexibility and resilience will help you overcome challenges and seize new opportunities. Next, let's talk about the importance of enjoying the process. Investing isn't just about the destination, it's about the journey. Take time to enjoy learning, growing, and watching your investments develop. Celebrate your progress and appreciate the lessons along the way. Next, let's discuss the importance of sharing your knowledge with others. Helping others learn about investing can be incredibly rewarding. Share your experiences and insights with friends, family, or your community. Teaching others reinforces your own knowledge and builds a supportive network. Next, let's talk about the importance of staying humble as an investor. No one has all the answers, and even the best investors make mistakes. Stay humble, keep learning, and be open to new ideas. Humility helps you avoid overconfidence and keeps you grounded. Next, let's discuss the importance of gratitude in your investment journey. Gratitude can make your investment journey more fulfilling. Appreciate the opportunities you have and the progress you've made. Being grateful helps you stay positive and focused, even during tough times. Next, let's wrap up with a summary of the key steps to creating a stock investment strategy that works for you. Wrap up: creating a stock investment strategy that works for you involves setting clear goals, understanding your risk tolerance, choosing the right investment style, and staying disciplined. Remember to diversify, keep learning, and review your plan regularly. Stay patient, flexible, and true to your unique journey. With these steps, you'll be well on your way to building a successful investment strategy tailored just for you.